Paul Scott here. I'm recording this video on the evening of the 25th of June 2016, the day after the momentous news of Brexit. Now, it's a Saturday today, and I've given some thought to what possible bargains there could be, given that the market dropped very significantly yesterday. However, a lot of shares rebounded after the big initial falls. So I've run a stock screen on Stockopedia just to see what sort of bargains there might be scattered around. Now, the screening tool here is really useful and really easy to use. You just click on Create a Screen to start a new one. I've done absolutely loads of them, so your screens here, these are all things here that I've created in the past. So Brexit Bargains, I've called this one. I put a question mark after the bargains. So I do emphasise this is just a shortlist for further research. Now let's just make that slightly smaller so it fits in the screen better. There we are. Now let's get rid of that thing. There we go. Right, now there are 53 shares qualifying for this, so I'll show you what rules I have created. So this is edit rules. So here we go. Let's make it slightly smaller again actually. There we are, that's better. Sorry about that. So I've chosen market caps of over 100 million because I don't want illiquid stuff. I think when the market's volatile and you want to be near to the exit door, in my view. So I want liquid stocks that I can get out of if I change my mind and the market really plunges. I should emphasise my overview here is that I don't think the plunge in the market or the spike down or dip or whatever on Friday, I don't think this is another Lehman's moment. I don't think the financial system will collapse. I think the system will cope on balance. The bank's balance sheets are much stronger than they were in 2008, and this is really a one-off event, I think, the Brexit thing. So my fundamental underpinning for what I'm doing here is that I think markets are likely to recover, or individual shares which have been heavily sold off. I don't know about the market overall. Also, this time around, I think the authorities know what to do. In 2008, they didn't, and it was chaotic. This time around, everyone knows how to shore up the system. So I don't see this turning into a major downturn, but I could be wrong. You know, if the UK economy does tip into a serious recession, which it might do, who knows? Then, so I reserve my right to monitor things and to change my mind and to get out of positions if things are worse than I currently anticipate them to be. I think it's business as usual, but probably with more profit warnings coming over the next few months and possibly a mild recession even. So I'm avoiding companies in particular sectors, so like marketing and anything that's sort of discretionary spending by corporates. I'm avoiding that. I think you're going to see a lot of delayed contracts and profit warnings because of that. So I think we've got to really tread with care here. However, going back to this then, so 100 million market cap more than for my stock screen. Now this one here, percentage price change over the last month, less than minus 10%. So in other words, I'm looking for shares that have dropped more than 10% in the last month specifically to see if there might be some bargains to pick up for a recovery. I'm not looking for long-term buy and hold things here. I'm looking for sort of trades really that might have 20-25% upside over the next few months possibly. Now the third item here is the dividend yield of greater than 4.5%. I'm a great believer in buying shares with good dividend yields generally, but I think particularly after a shock to the system, high yielding shares should have a solid sort of underpinning, providing that yield is sustainable. And then finally, price to tangible book value greater than 0. That's just basically saying I don't want companies with negative net tangible assets, just to screen out any really ropey balance sheets. So right, then you click on get qualifying shares. It tells you here there are 53 shares qualifying. Now they're currently shown in order of descending market cap, and I've put the yield here as well. You can customize this view here very easily by clicking on that little edit button there. So you can select which fields you'd like to show in the table. They don't have to be fields that you've screened on. You can put any field in there. So this is the overview screen. So look at that, forward, and the yield rolling is a forward dividend yield of 8% on Lloyd's Banking. That's got to be worth a look. Jim Mellon actually put something out on Twitter today saying this is his top share pick at the moment, because it's basically dropped 20%. As you can see, it's 57p now. Whoops, 57p now. But look, before Brexit it was 72, 73. So that spike down to there is purely on Brexit. His idea is that it's solid as a rock, I think, to use his phrase, and he thinks it's going to come back again. So that could be a 20% gain, and certainly the 8.1% yield is incredibly attractive if it's sustainable. Forward P is very low as well, so I might pick up a few of those on Monday. I'm not sure. I don't usually invest in banks. Aviva and Legal in general, not interested in those sectors. Now, let's sort by dividend yield. Okay, so the highest one, interestingly enough, is Galliford Try, which is a house building outfit. Bear in mind, I don't normally really look at large caps, so I'm not an expert on any of these by any means. And nothing here is recommendations. It's all, just my thoughts. Do your own research, obviously. I did buy some of these on Friday, actually, Galliford Try, as Richard Crowe reckoned they're really good value. And look at that, 9.7% forward yield. Oh, for God. Just stay on there, will you? It won't do it. Oh, yes, it will. Right. 9.7% forward dividend yield, 6.8 PE. That's down to 1,040. And look how it's dropped over the last year. It's almost halved. Now, so the market is clearly pricing in a fairly significant downturn in the UK housing market. I don't think that's going to happen. I really don't, or I think it's unlikely anyway, because prices are, okay, yeah, we all know, very, very expensive on historical multiples of price to average earnings or median earnings. But in the context of very low interest rates, property is still quite affordable, apart from, in central London and, well, in posh areas of outer London as well. I looked online, mortgage rates are sort of 4.5% or something, with base rates at 0.5%. So even if interest rates go up, I think you're going to see the bank's margins squeezed. I don't think necessarily interest rates will go up anyway. We've probably got another wave of QE coming. Look, these are all what ifs, but I think generally my overview is I don't think UK housing. I think we've still got a chronic lack of supply in the southeast. I think they look potentially interesting if confidence returns. And look at the next one, 9.1% dividend yield on Taylor Wimpey. Similar sort of PE again. Barratt Developments is there as well. And Barclay, all these big house builders, Crest Nicholson, currently yielding terrific amounts. Persimmon, which I've bought some of on Friday as well. So I think those are interesting. Obviously, the dividends may not be sustainable at that level if you think the housing market's going to crash. Now, let's click on this one here, because you can sort by these headers. That shows you the biggest price drop now in the last month. Hostelworld is interesting, and I do hold some of these already. I bought them too high at about 170, topped up at 150. They're now 133. But look at that forward dividend yield, again, 8.7%, and more or less equal to the PE. Now, this is a recent float that has disappointed, but the profit warning wasn't that bad, actually. I did a report on it in my morning report. Woodford's in this one, and I think he's been buying more. I think that one's interesting at the current level. It's an absolute cash machine. It spends about 45 to 50% of its revenue on marketing. Very interesting potential recovery stock, I think, although there's not a lot of growth there. That's the only downside. It's possibly a mature business. What were we looking at? Oh, these are the biggest price drops. Now look how the house builders here, Taylor Wimpey, Crest Nicholson, Persimmon, Galliford Try, Barratt's are really all bunched together. Bellway there, Bovis Homes. These are the Barclay. It's just a wodge of house builders there who are the biggest fallers in the last month. Sorry. Excuse me. It'll go off in a minute. So I think that's quite interesting that biggest falls in the last month are mainly house builders. So I think that whole sector is interesting, and I'm buying shares in that at the moment. A couple of others here are worthy of note. Halfords has dropped a lot. I think that was overpriced to start with, and it's probably now about right. But 10.3 PE, 5.1% yield, not bad. Retailers, I think, are one of the other sectors I think is looking very interesting at the moment. There's Debenhams. I don't hold that one at the moment, but I'm very tempted at 58p. 6.2% yield, 7.4p. Does have quite a bit of debt. There was a recent statement from that saying like they were in line, but only just. The like-for-likes had dropped a bit, but it was still positive for the year to date. Quite an interesting stock. So house builders I think are very interesting at the moment. Retailers I think are very interesting. Retailers generally could be hurt, or they'll see margins squeezed from the stronger dollar against the pound, because they generally source a lot of stuff from the Far East and are invoiced in US dollars. But they're forward hedged, most of them, by a few months, apart from Sports Direct, which put out an RNS on Friday saying it wasn't properly hedged. So that's why that one fell quite a lot. This is an interesting one, Matchtech. I already hold that one. It's a pretty good quality recruitment company. They bought, what was it called? Networkers International. So it's expanded a lot. Again, another one where the PE and the yield are more or less the same, 7% in this case. I think that's very interesting. I'm probably going to buy more. Although recruiters, I think, probably not a great sector to be in at the moment. I would imagine companies will hold back on recruitment decisions. So I would only buy recruiters if they're on a very low PE, because those forecasts could well be revised down. Other ones here that look interesting, you got Marks and Spencer's down 18% year in the last month. Again, 6.8% yield, not bad. Pretty much a sort of high street bellwether. I'm skipping these because I don't know them. Foxton's possibly an interesting one. People seem to think central London property is going to crash as foreign money leaves. I'm not convinced about that at all. I think you might well see London become a bit of a tax haven sort of outside of Europe. So I'm interested. 8.9% yield. It's worth looking at, isn't it? Another house builder there. Restaurant Group. Now this is one I already hold. I think this is sitting duck for a takeover bid. You won't believe this, but I was actually filling my boots with these on Friday morning at £2.45ish, that sort of level. They opened down £1. I couldn't believe it. I just hit the buy button over and over and over again until I had filled my boots. I did the same with Next as well. That opened at £40. Sold them half an hour later for £49. So there were some amazing dislocations when the market opened on Friday. I got some wrong as well. I bought some Barclays and sold them at a loss. There were a couple of other cock-ups as well. I bought the house builders far too early, so I'm well underwater on Persimmon at the moment. Some you win, some you lose. That's life. EasyJet, I bought some of these on Friday at about £12.85. Again, 5.8% yield, 8.2 PE. Somebody pointed out to me that they might have issues with the European scheme, where the airlines all sort of can fly in and out of each other's airports. Although EasyJet did put a statement out, which is a bit non-specific, but saying that they've basically got contingency plans and it shouldn't materially affect them. So very nice business, looking cheap. I'm probably running out of time now because the file's going to get too big otherwise. So yeah, really good screening thing. You can look also at the stock ranks. You've got all these options up here. Where's the ranks thing? Oh, what's happened? Why has the screen gone off? Oh, fiddlestick. Something always goes bloody wrong, doesn't it? Well, let's see if that comes back on. Otherwise, I'll have to do the whole thing again. FFS. WTF. Let's turn the monitors off and on again. Have you tried turning it on, off and on again? No, I'm afraid my lovely video has gone wrong. Ah, it's come back on. Okay, let's turn it off. Sorry about that.